This is the Sensei Podcast, where we help you make sense of investments and financial markets, where we help you make sensible financial choices. I am your host, Ndwati Karanja. Borrowing money in order to invest in something is very attractive. Using other people's money to invest and then you reap the returns is something that we all desire. And sooner or later in your journey as an investor, you'll find yourself faced with a decision that you need to make, whether you should borrow money to take advantage of an investment opportunity. Because think about it, borrowing money, for example, to build flats can greatly accelerate your progress towards your goal rather than taking the time to save bit by bit and then build them up. And so the question is, should you borrow money in order to invest? We've all heard of major business failures in our country over the last couple of years. And if you read the news, you've probably come across stories of prominent businessmen and politicians being taken to court by banks over money that they had borrowed. And the fact is that whenever you're borrowing money in order to invest, you're playing with the big boys. And if some of the big boys don't know how to manage that situation, that they end up in trouble, then for you as an individual investor, it is going to be a very difficult situation. Therefore, my answer is that in the vast majority of situations, the answer is no. You shouldn't borrow money in order to invest. And as we proceed with this episode, as we talk about different things that you need to think about, whenever you are using borrowed money to invest, you'll realize that the circumstances where you can safely borrow money in order to put it to an investment are very few. And therefore, stick around to hear about the things that you need to think about when borrowing money in order to invest it. You need to think about the duration of the loan that you're going to borrow. You need to think about the total amount of money that you need to borrow. And finally, you need to very, very carefully consider the nature of the returns of the investment opportunity. Let us start with the first of these, the duration of the debt. The first consideration that you need to make is what is going to be the time frame for the debt that you're going to take up in order to use the money to invest in an opportunity. And the thing that you need to keep at the forefront of your mind is that the longer the time frame of the investment, the more uncertainty that is going to be involved, the more risk that is going to be involved. Let me give you an example. When the government is borrowing money for 3 months, using a treasury bill, they typically pay an interest of about 7%. On the other hand, if they're borrowing for longer periods of time, for example, 18 years, they are going to pay an interest of about 12%. That increase in the interest that they are willing to pay as they increase the amount of time that they're going to be borrowing is to compensate the investors for the additional amount of risk that is going to be involved. And the reason for this is that the longer the period of time that you are going to be involved in a situation, the less predictable it is. You do not know what is going to happen far into the future. You can very easily predict what is going to happen 3 months from now. However, when you're talking about 18 years into the future, it becomes harder and harder for you to predict that. Therefore, for that additional uncertainty that you're going to be bearing, you're going to be compensated at a much higher rate. You need to bear this in mind as you're borrowing for investments. It is advisable that if you're going to go the route of borrowing for investments, it's going to be for short-term opportunities that are pretty clear. And the reason for this is that it is easier for you to cut your losses in case of anything going wrong if it is for a short-term situation. But if it is for a long-term situation, the greater the amount of losses that you are likely to to face. And if you have an opportunity that is quite long term, it makes more sense for you to save up the amount in order to take advantage of that investment opportunity, or you could go out and look for investors, people who are willing to bear that amount of risk that is involved in a long-term thing, rather than you going to a bank and borrowing money and then you bearing all the risk that is involved in that long-term investment. Therefore, the shorter the duration of the loan for that you borrow in order to invest, the better. When you're dealing with long-term investment opportunities, either save up the amount or go look for other investors who can share the risk with you. The next thing that you need to think about when you are borrowing money to invest is how much you're going to need to exploit that investment opportunity. The second consideration that you need to make when you decide to borrow in order to invest is how much you are going to borrow. And this is linked to how much is needed to take advantage of the investment opportunities. And to reason out this situation, we need to remember that the reason we usually borrow money in order to invest is because it is going to magnify the amounts of profits that we are going to make. Let us create a scenario. You have an opportunity that requires you to invest 100,000 shillings. You have saved up 50,000 shillings. The return from that investment is going to be 30%. And if you're going to borrow 50,000 from, let's say, a bank, you're going to pay 14% in interest. If you invest half of your own money and then borrow the other half in order to top up for the investment, your total return is going to turn out to be about 46% because of that additional amount that you're going to earn from the borrowed funds. So you go from returns of 30% when you invest everything on your own to 46% when you borrow part of the amount. However, in the same way that the debt is going to magnify the returns that you're going to be making, it's also going to greatly magnify the losses that you might incur in case things don't go well. For example, if instead of making a return of 30%, you make a loss of 30%, your losses are going to be magnified to 74% if you are going to be borrowing the money. Therefore, remember that whenever you are borrowing money in order to invest, your profits are going to be magnified if things go well. However, your losses are going to be even greater magnified in case things do not go well. Therefore, it is usually advisable for you to use as little debt as possible. When investing in a good business, you don't want to invest in a business that has more than 30% of its financing in the form of debt. You want at least 70% of its financing to have come from shareholders, and then this is topped up by about 30%. And therefore, when you find yourself as an individual, you are in a situation where you have borrowed more than 30% of what is required to take advantage of that investment opportunity, realize that you are in a dangerous situation, and in case something goes wrong, the amount of losses that you're going to face is going to be greatly magnified. If you decide to go the route of borrowing money in order to invest, remember, the less that you must borrow compared to your savings, the better. The final thing that you need to consider, and the most important thing, is the margin on the returns. The margin on your returns is the difference between the returns that you're going to get from the investment and the interest that you need to pay for the amount that you have borrowed. Your returns need to be great enough to compensate you for the additional risk that is involved when you're using borrowed money. The returns need to more than cover the interest that you're going to be paying for the loan. When the difference between the returns and the interest that you're going to be paying is small. For example, if the returns are 30% and the interest that you need to pay is about 25%, that is a very small margin. And you'll find that the amount of profits that you're going to be making, they're not going to be as greatly magnified as when the margin is greater. However, when that margin is small, the amount of losses that you're going to be making are going to be even more magnified than they are when the margin is great. Therefore, make sure that whenever you are going to take advantage of an opportunity and you decide to take a loan, the difference between the returns that you hope to make and the interest that you need to pay on the loan needs to be as wide as possible. Otherwise, you're not going to be gaining much benefit from that loan, and you're also going to be bearing greater risks in case something goes wrong. Your losses are going to be magnified to a greater degree if that margin is very small. And the way to approach this is to think about the worst case scenario. Whenever we have an investment opportunity in front of us, we tend to think about the best that can possibly happen, the best returns that you can possibly make, and then we plan using those figures. However, when you have a loan involved, it is always better to make sure that you have the worst case scenario in your mind. What can possibly go wrong? Can you lose all the amount that you have invested? Can you lose a significant amount of it? Can things not turn out the way you expected them? For example, if you are going to borrow money in order to build houses that you're going to sell later, it is possible for you not to get a buyer for those houses for a very, very long period of time. So that will be one of the worst case scenarios that you consider. And when that happens, you need to understand what is going to be the impact on you, considering that you have a loan that you need to keep paying. Therefore, you need to be very clear about the worst case scenario and then plan using that worst case scenario to prepare yourself for things going wrong in your investment. Therefore, remember that the wider the margin that you're going to be making on the returns, the better the situation you're going to be in. And also remember, think about the worst case scenarios in terms of you not getting the returns that you're expecting, and prepare yourself for what you're going to be facing. Therefore, let us conclude. It is not advisable for you to borrow money in order to take advantage of an investment. But if you must, remember that you only borrow for clear short-term opportunities. And if it is a long-term investment opportunity, consider saving up for it or getting investors. Finance as much as possible of the investment opportunity from your own savings and from other investors rather than from borrowed money. That is going to help you limit the amount of risk that you're going to be facing. And finally, consider the margins on the returns. There needs to be a wide as possible margin between the returns you're going to be making and the interest that you're going to be paying on the borrowed funds. Think about the worst case scenario as well in case something goes wrong, and then prepare yourself for that eventuality. Investing using borrowed money is a very technical thing that even experts usually have a difficult time managing. If you're a beginner investor, or if you're not familiar with the kind of investment that you want to take advantage of, absolutely avoid borrowing money in that situation. Don't even think about it. If you're an expert investor and you decide to go the route of borrowing money in order to take advantage of an investment, proceed with the great caution that situation deserves. Investing using borrowed money requires extreme discipline and level-headedness when you're planning and when you're executing it. Therefore, remember these things that we have covered. As a beginner, absolutely avoid it. If you're an expert investor and you decide to go ahead with it, proceed with the caution that it deserves. This has been the Sensei Podcast. We release new episodes on Wednesdays and Fridays. Please subscribe and leave a comment on your favorite podcast provider. I am Ndwati Karanja. Until next time.